Many of you who know as well, this slide will be old news, but to those that are new to Law Debentures journey, and 39% of you are not owners in Law Deb, Law Deb consists of two distinct and complementary parts. The piece on the left, which is managed by Laura and James, is our investment portfolio, which is 81% of the NAV. And that's the more traditional investment side of our business. And the piece on the right is the independent professional services business, which accounts for 19% of our net asset value, but crucially has supported a third of our dividend over the course of the last 10 years. So this is quite a nice two-way relationship. Firstly, if we can generate steady cash profits in the right-hand side in the professional services business, that gives Laura increased flexibility in portfolio construction that we believe, and history tells us, will produce material outperformance versus our benchmark over time. But going the other way, it's incredibly helpful when we're pitching for business as the independent professional services businesses to be part of a £1.2 billion FTSE 250 company with 135 years of history, particularly when a lot of our competitors are private equity owned or relatively new and with short-term track records and weak balance sheets. So if we can go to the next slide, please. Okay, so just like Laura manages a portfolio of stocks, the professional services businesses are made up of a portfolio of businesses. We break those down into three buckets, but as you can probably see from the third one along, the corporate services business, that in itself is a collection of businesses. So I'll just talk briefly about those. I'll spend about 10 minutes in total before Laura talks to the share portfolio for about 20 minutes after that, and then we'll take Q&A. Should have said that at the start. We'll start in the middle. Law Debenture was set up 135 years ago as a bond trustee, and that sits basically in between the issuer and borrowers in a bond transaction. And we receive inflation-linked fees most of the time for our work there, and we can receive ad hoc fees for our work there if there's changes that need to be made to the trust indenture, or indeed if the company goes bust. If the company does go bust, at that point we go behind HMRC and the liquidator in terms of the creditor profile, and we only need to do work if we're secured or indemnified to our satisfaction. So there's a big element of counter-cyclicality in there. For those that know Law Deb well, they'll know that between 2009 and 2011, during the global financial crisis, our earnings grew very well, and that was driven in very large part by the corporate trust business. Switching to the left-hand side, we're a pension trustee. Think of that as being the independent non-executive director of UK private pension schemes. We've been doing that for 53 years. Combination there of paid by the hour and some fixed fee work. And increasingly our business is driven by what we call Pegasus. And Pegasus not only does the director type work, will act as the secretary to the scheme and will help people complete projects that they need to do in order to discharge their obligations as a board. And on the right-hand side, a collection of services which are company secretarial, accounting, service of process, and whistleblowing businesses. Two of them are relatively large, this COSEC business and the whistleblowing, the service of process business, while the accounting business is relatively modest and whistleblowing is our fastest growing business. If we look at how they did last year, you can see as a collection of portfolio businesses, they produced 6.2% growth in revenues, and our PBIT, profit before interest and tax, was up 6.4% in the same business in the same period. And as a business, we're very much looking to achieve mid to high single digit growth in PBIT over time. And we've managed to achieve that for each of the last 7 years. So we can move on to the next slide, please. Just wanted to highlight here outlier years, because when you look at the previous slide, and please go back to this previous slide, but you could be forgiven for being slightly disappointed with the pensions number, which showed it down 4%. You might think there's a problem there. Occasionally, we get extraordinarily good years in our businesses. And 2023 was an extraordinarily good year in our pensions business. We did say this at the time. We did write this in the annual report. We did say this at the AGM. We said the planets lined up. It's a thank you note that will never be written to Liz Truss and Quasi for the autumn statement in 2020 2022, but that led to a significant re-rating in the assets and liabilities of UK pension schemes. That was a call to action during the last days of 2022 and throughout 2023 and into the early days of 2024. Because the call to action was, what do we do now? Our asset and liability profile has changed substantially. Do we lock that in? Do we partially lock that in? Do we move to buyout or buy-in? So there's a huge amount of project work for us through 2023 and into the early part of 2024. The business grew by 21% last year, and we were at pains to point out it's a great business, but mid to high single digits is where you should anchor yourself. And clearly, when you've had a great year like that, it's very, very hard to keep up with the comparators. Interestingly, it's got a 5-year compound annual growth rate of 9.5%, which is the same as our corporate trust business. And I wanted to illustrate again, in 2020, corporate trust had an outlier year. Didn't mean to say in 2021 it was a bad year when the earnings were down. Over time, that produces great returns for our shareholders. And we believe we can continue to grow both of these businesses in that 5 to 10% range over time. Next slide, please. So going to what that happens at a portfolio level, and this is maybe slightly old news. We do produce daily net asset values, but you can see that we materially outperformed our benchmark during last year. And crucially, you can see that we do that over the long term as well. And when we're investing our capital, we've very much got an eye on the long term. IPS is, as I mentioned earlier, it's covered a third of the dividend. And in the bottom table, the numbers are a little bit small, but crucially here, you can see that our dividend over the course of the last 10 years has more than doubled, going from 16.2p in 2014 to 33.5p in 2024. And our ongoing charges ratio is relatively modest at 51 basis points versus an industry average of 105. Next slide, please. Okay, this slide is here just purely to show how we fit versus other people in our sector with more than 500 million of assets. And I think to some degree we can flick through that. It's a very good slide, shows our performance is very good, but not really accretive in the context of the time we have today. So 5-year performance in the underlying businesses within the professional services business. As you can see, nice portfolio, but over time, it's producing that PBIT growth in that mid to high single digit range. Crucially, on the bottom right-hand side, we have increased our fair value of the IPS business over time from just over 100 million to close to 200 million, 83% over the course of that 5-year period. Tiny change in the multiple. It's still conservatively valued at 10.5 times. It's 10.5 times EBITDA, and clearly we're driving that EBITDA northward. So we're looking to grow our capital over time. If we grow our capital over time, then good things can happen to the dividend. So I think the final slide, please. So in summary, all of the IPS businesses have high margins and high returns on capital. We think of about 2/3 of the revenues with them as being repeatable. But crucially, these are cost-in businesses. We are going to invest in these things. We're not looking like private equity to maximize the profits of these in the short term and sell them. We think that wouldn't be in the interest of our shareholders over time here. We're looking to invest and grow these earning streams over time, because if we can grow those cash profits steadily over time, Laura has more choice in portfolio construction. So with that, I'll hand over to Laura. Thank you.
Thanks. Hopefully everyone can see and hear me okay. Let me know if not. I thought I would start with the investment approach before I go on to what performed well and badly last year. The investment objective here is to grow capital and grow income. And the focus is very much on the former and let the latter be an output. So what I mean by that is Dennis is described very well his IPS business. And the nice thing about running this particular trust for me and James is that every year when we come in, we know that the IPS business is roughly 20% of the NAV, but most importantly, we know that we've got about 1/3 of the income in the bag for this trust. Now, what that allows me and James to do is focus on growing the capital and letting the income be an output, because we know we've got that 1/3 in the bag. And that, I'll go on to talk, and you can see that in the performance numbers, but I can't kind of overemphasize how important that is in the overall structure of the trust. In terms of how we run the portfolio, it is deliberately diverse. It's diverse by sector and geography. We are not running this in any sort of thematic approach. And we have about 150 stocks at the moment. That's not unusual for this trust. One way you could think about it, if you want to think about the overall structure, is you could think that we have one position in IPS, Independent Professional Services, that is effectively 20% of the trust NAV. So the investment portfolio, which James and I run, is almost diversifying away from that 20% of the NAV that's in the IPS business. So the way that we run the portfolio is don't mess up effectively, if we're being really honest, because we know we've got a good asset and 20% of the NAV in IPS, and the portfolio, its job, we're not taking on too much individual stock risk. We're trying to diversify away from IPS. In terms of how we think about running the portfolio, it's a value-driven process. What we're looking for is market-leading businesses, ideally on a global scale, but we're buying them, most importantly, we're buying them at the point where we think they are undervalued maybe relative to their own market, relative to peers, relative to their history. This gives us a margin of error. If things go wrong, sometimes they do. At the moment, you could almost buy most of the UK equity market, most of the UK shares, and they would fall within this bucket. And we can talk about that and why there's sort of a valuation discount on UK equities at the moment, and they're roughly 88% of this portfolio. And finally, we do go overseas where there's no UK equivalent. So we have a roughly 12% overseas allocation at the moment. It tends to be in sectors like pharmaceuticals. That's very much a global sector. Why restrict ourselves to just GSK and Astra that are listed here in the UK? We can also own and do own the likes of Roche in Switzerland, Sanofi in France, Bristol Myers in the States. If we flick to the next slide, this is what performed well and badly over the last 12 months. If we look at the best contributors over the last year, so Rolls-Royce in here, that's been one of the biggest positions at times over the last year. We have started to reduce, 65% share price appreciation. That's really come through a combination of self-help. Under a new chief exec, they've become much more commercial in terms of how they're pricing. They've taken a significant amount of costs out of the business, but it's also a feature of end market tailwinds. In other words, so Rolls-Royce, remember, this is jet engines, nothing to do with luxury cars. This is engines for the likes of defence, but also civil aircraft. They make money when planes are up in the sky and flying. They've really benefited from us all going back on holiday post-COVID. So it's been a combination of, yes, new chief exec doing lots of good things, but also a helpful end market undoubtedly benefiting them as well. Like I said, we have begun reducing that position and taking profits in the area. The other area that did very well over the last year was bank holdings, so the likes of Barclays and NatWest we can see here. They definitely benefited from a higher for longer interest rate environment. In other words, we had the decade or so just over post the GFC, the financial crisis, where interest rates were near enough zero. That's a really difficult environment for banks to make money. And once Ukraine happened, we saw inflation go up, interest rates go up. That's a much more beneficial environment for the banking sector. They're suddenly making returns, comfortably into the double digits. We've seen valuations move up and share prices move up as a result. And similar to Rolls-Royce, we have begun taking profits in that area. It's not to say there's anything wrong with these companies. It's just that we need to stick with that valuation discipline and recycle the proceeds elsewhere. The likes of Flutter has also been a good performer. This is Paddy Power Betfair. You might know the brands. It's rolling out in the States. The States legalizes slowly. That's potentially a very long source of earnings growth for a company like that. And the shares have responded well. And then finally, M&S, as a brand that I'm sure everyone's well aware of, under a new chairman and a new chief exec, they've done lots of very sensible things to turn that business around. Things like making the prices more competitive in both food and clothing. And on clothing, most importantly for women's wear, they've really refreshed the offering there. And you can see it reflected in market share data, but also earnings as well. So that's the sort of individual shares. One point that I would make before we talk about the detractors as well is that the likes of Rolls-Royce and Flutter and M&S would all have been difficult to hold in size in a traditional income fund. And the reason I say that is that Rolls-Royce and M&S are now back on the dividend list, but in a very modest way, dividend yields that would be comfortably below the wider UK market, for good reason that these were businesses going through a restructuring and it wasn't right for them to pay a dividend while they were still in the depths of that restructuring. But because James and I knew that we had the income from the IPS business, we were able to hold Rolls, Flutter, and M&S and hold them in size as that restructuring came through in a way that would have been pretty challenging if we were trying to meet the FTSE All-Share benchmark dividend yield. If we then turn to the detractors, and hopefully the diversity of the portfolio is coming across, AFC Energy is a pretty small cap, it's 50 million market cap now. It's hydrogen fuel cells focused on the construction industry. So rather than using, if you're Balfour Beatty or Kia, rather than using a diesel generator, you might use a hydrogen fuel cell generator from AFC Energy. The challenge has been scaling up that technology. It's pretty nascent. They've got a JV with Speedy Hire in the UK, but it just hasn't scaled up to the degree that we would have hoped, say, a year, 18 months ago. And you've seen that reflected in the share price. The likes of Rio Tinto and BP, I say just bear in mind these are just the share price numbers rather than total return. Both of those companies pay quite a healthy 6% dividend, roughly 6% dividend yield as well. So they haven't been quite as bad as necessarily this table reflects, but there has definitely been a degree of commodity price normalization post the spikes that we saw in the Ukraine year, and that's washed through. And I think it's fair to say with BP, there's also been some more strategic missteps, should we put it that way, as well. And then with the case of Vanquis, that's a consumer lender, it's credit cards, some non-prime credit card lending, whereas that's been a very long restructuring story that's had problems of cost overruns. It's now on a very low valuation. It's a pretty small position for us. And finally, Next 15 Communications is a global agency, it does media, PR, a lot of the time for tech businesses, which has been those companies, the alphabets of the world, have been focused on spending on AI rather than spending on PR. And that's why we saw the earnings progression disappoint at a company like Next 15. If we then flick to the next slide, this is a much longer term time horizon. So the previous slide was a year. This is 5 years. And hopefully what this table will get across is the advantages of the combined structure. And what I mean by that is, somewhat frustratingly, as someone that runs income funds, a large number of these best performers have been non-yielding shares. So Rolls-Royce, I've mentioned, Ceres Power is another alternative energy name in the hydrogen fuel cell space that performed very well in 2020. We've spoken about Flutter and M&S. The likes of Applied Materials in the States would also be a low dividend yield share, as would Croda. So hopefully it's coming across that greater investment breadth that we have because of the contribution from IPS has really benefited performance over time. And then if we think about almost the flip side of the same coin, we haven't had to hold higher dividend yield shares either. Unless we are very welcome and happy to hold high dividend yield shares if we think they're an attractive total return. What I mean is that we don't have to hold anything. So you can see here that we have not held Diageo. We don't currently hold a position in Diageo. That has been quite a big detractor for the benchmark. We haven't felt the need to go there. I'm happy to talk about that if anyone has any questions. And then finally, the third point that's benefited performance is that ability to go overseas. I think most people will be aware how much the US market has outperformed the UK market over the last, say, 5-10 years. That has benefited this trust performance over time because we have dipped into the US on occasion, holding at times the likes of Microsoft, the likes of Johnson & Johnson. We currently hold Cummins. That has also benefited relative performance over time. If we then flick on to what we're doing right now, I would say at a high level, the first thing we're doing is investing more in the UK. So as it says here, we've got 88% of the portfolio invested in the UK at the moment. That would be higher than it was a couple of years ago when it was nearer 80. This is a few years ago now. And the justification for that in the face of, as I mentioned, UK equity underperformance is really valuation. So what the chart here is showing you is PE, price to earnings, for the UK relative to the MSCI world. And the MSCI world these days is pretty dominated by the US market. So what this is trying to get at is normally, if we look at the median line, the UK equity market does historically or has normally traded at a discount to the MSCI world of around 15%. So it's not suggesting that UK equities should trade at a premium. It says it normally trades at about a 15% discount. But where we are now, and sort of no prizes for seeing the point at which that valuation gap really emerges, it's Brexit. UK equities are more like a 40% discount to the rest of the world. So that's really stark on any long-term historical timeframe. And I think most importantly, it also holds if you do this on a sector adjusted basis. So what I sometimes get back from investors and clients is, well, that's because we don't have a Microsoft or an Alphabet. And that's completely correct and right. We don't have the equivalent of those. But even if you adjust for that, UK equities on a like-for-like basis look like they're on more like a 20% discount rather than a 40% discount. And in terms of, because I'm sure lots of people on the call have heard other UK equity fund managers talking about this gap as well, but I think what's interesting is that the amount of takeover activity that we're seeing would suggest that we are not the only people seeing this valuation anomaly. So what we've seen in this trust over the last year, and it's even extending up to the top end of the UK market now, is a higher degree of takeover activity. So, for example, we saw International Paper, which is a US listed company, come in and bid for DS Smith in paper and packaging. We've very recently seen a company called American Axle bid for Dowless, which is the old GKN, if anyone knows it. We've had bids for even the likes of Anglo American, that didn't go through. The likes of IDS, in other words, Royal Mail, got bid for by private equity. I could go on. There's a lot of external evidence of this UK valuation discount. So it's not just a load of UK fund managers saying it, it's also, there's been some external validation of that. If we then flick to, so that's what we're doing very high level. If we flick to stocks and think about where we're adding and what new names are coming into the portfolio, we've recently taken new positions in two other fund management groups, being Shareholders and Aberdeen. These are not companies that we've owned for a while, or at least a year or so. In both cases, there is now a CFO in charge. And actually, they're quite similar stories. So you've seen these CFOs being promoted to CEOs. And so far, it's relatively early days, but so far they're showing a renewed cost discipline, perhaps something you'd expect from a CFO being put in charge. That's being taken well in both cases. In the case of Aberdeen, it's more of a sum of the parts argument. Aberdeen own Interactive Investor. Maybe some people on the call use Interactive Investor. It's seen as a very good platform, low cost if you have a certain amount invested, and we think that that's an underappreciated asset in something like Aberdeen. Elsewhere, we've been adding to some renewable infrastructure trusts like the Greencoat UK Wind, which is trading around a 25% discount to NAV, high single-digit dividend yield. That's more of a total return argument. If we think that 9% yield is sustainable, which we do, that looks relatively attractive. And the likes of AB Foods, which is the owner of Primark, and that's what people tend to focus on, but it's also got a global brand portfolio, so it owns the likes of Twinings, the likes of Ryvita, Patax, and people focus very heavily on Primark like-for-like sales, which have been tough. The UK consumer environment is broadly tough, but actually the global brand portfolio is making good progress. And something like AB Foods would be trading at pretty much the lowest valuation as it has in the last 20 years, on around 10 times earnings. To fund those positions, because the gearing level has been roughly constant. We've got a low teens level of gearing. We've been recycling and reducing names like Flutter Entertainment and M&S, which perform well. And then on Dowless, which is the old GKN, when American Axle made that bid, we chose to move on from the position. So we recycled those proceeds elsewhere. If we then flick to the portfolio, I think there's a couple of things I draw out. First is that the position sizes of the top 15 names do look relatively low compared to, say, some shorter list, higher conviction portfolios. Going right back to the beginning in the structure of the trust, we are diversifying away from that 20% position in IPS. So we are deliberately trying not to take on too much stock-specific risk. And that's why if you look at these top 15 names, you quite quickly get to relatively small holdings, the likes of BT, NatWest at 1.3, and then there is a long tail, which gets you to the 150 holdings. In terms of sectors, as I mentioned again, it's pretty deliberately diversified. The one area on this which doesn't look diversified would be the 88% holding in the UK. But always worth bearing in mind that those are predominantly overseas companies. So it looks like we have 88% in the UK. In reality, we don't. We have about 40% in domestic UK. The likes of GSK, let's see here, 2% position in GSK. It's UK in name only, really. Something like that could feasibly, I'm not saying it will, but it could feasibly up a list elsewhere. It just happens to be listed on the FTSE. If we then flick on to conclude, and hopefully we'll get lots of questions as well. We are seeing no shortage of opportunity in the UK at the moment. As I mentioned, UK equities are trading at a substantial discount to the MSCI World, more so than they have done in the last 20 years. So we're trying to take advantage of that as best we possibly can. And within that, use the advantages of this particular structure and trust, where we have the opportunity and really the privilege to invest across the breadth of the UK market, rather than focusing on a narrower yield cohort of yield stocks. So I will stop there, and hopefully we will get some questions.
Thanks very much, Laura, Dennis. Just encourage anyone, if you'd like to ask a question, do type your question into the Q&A box. So the first question we have so far is, would we look at growing the IPS to generate income that is 25 to 30% of assets under management? Which area would this come from?
Okay, so I'll go with that. So we don't have a target for the percentage of net asset value. Right? I think that's sort of the question reversed around. So currently 19%. And in the 7 years I've been here, I think we're between 19 and 25%. Obviously, some of that can be, what we don't want to do is achieve that growth by the fact the portfolio shrinks. So ideally, the equity portfolio will continue to grind higher over time, and Laura's just articulated very good reasons as to why. But I think hopefully the two can grow hand in hand. And if we're in that sort of mid-teens to 30% range, but crucially, as long as we're covering around a third of the dividend, then that's really accretive to the whole. And I think that we would only have to think about the relevance of IPS if you get down, if we're no longer covering a large part of the dividend of the organization, or indeed if it went over I mean, I'm being extreme now, if it got to 50% of that, people might say what I'm buying. I don't think they're realistic outcomes for us, barring something spectacularly good happening to the IPS business, which would be outside the scope of the earnings that we think we can achieve over time, or something spectacularly bad happening to the equity market, which again we would not view as something that would be sustainable in the long term.
Thanks, Dennis. Then Bob asks, given the new government's track record, when do you see the UK market picking up? That's a difficult question.
That's Laura.
Yes.
Very, very good question. And the proper answer is, I don't know. Yeah. But we're starting from a portfolio on, hang on, let me get the very precise number, 10.4 times forward earnings with a yield of 3.9. I always think that valuations are the best guide, and that is a very low valuation compared to history for this portfolio. I mean, maybe let me just, if we've got a bit of time, let me give you a sense. I spent a lot of time with UK companies last week at a conference. So this was the likes of, so things we own here, Ibstock, Bricks, Marshalls, Paving Stones. And actually it was pleasantly, cautiously positive, in that these companies are saying things aren't getting incrementally worse. If anything, things might be getting very gently better, from a point where sentiment is really quite weak towards UK equities. If I were to do a survey across the floor of UK fund managers, they're pretty down. So sentiment is poor, valuations are low. I think companies have really learned that they need to get expectations in the right place, really nail down expectations. So I came out of that conference and meetings actually pleasantly surprised in a gentle way, and I almost feel reticent saying it because I feel like sentiment is so poor towards the UK and in some cases the Labour government as well. It's not to say they haven't made what I might view as mistakes with regards to national insurance and things. I think they have, if I'm being really honest. But we are where we are, and valuations are where we are, and I think there's some pretty low expectations and low hurdle rates out there. So I'm sort of cautiously optimistic and feel almost nervous saying that. But I always come back to valuations, and just over 10 times earnings is I think is a good place to start.
I mean, in terms of general economic pickup, I think the effectiveness of the planning reforms that the government is trying to put in place will be fairly key. I mean, there was one announcement today, which is quite important for a company I hold in my own portfolio, which was the announcement that the Lower Thames Crossing is proceeding. And that's I think it's a £6 or £7 billion project. So
yeah.
I hold a company called Hargreaves Services. Don't know if it's one you've ever looked at, but they're lined
That's
up
not
to
one of
do
ours,
the
but we do
Sorry.
the likes of Balfour Beatty.
Yeah, they're
that's
partnered with Balfour Beatty, who are the prime contractor there. So yes. So do you hold Balfour Beatty in your portfolio? Yeah. So that they should benefit from that, for example. So yeah, there is some hope with these things. We shall see. And then obviously the longer term, after they've been constructed, these infrastructure projects are economically beneficial in general. They should improve the productivity of the country as a whole. But it's a long and rocky road. Okay, then next question. Taha asked a question I was going to ask myself. They're not quite in the manner he or she has. I said 150 stocks is quite a lot. How big is the team you have supporting you, Laura, in that? Because to keep on top of that many companies yourself is a bit much.
Completely agree. So that it's only James and I are managing the portfolio, but what people don't see is that I'm sat on, I won't turn around my camera because I'm worried about breaking my laptop. But I'm sat on a floor with European PMs, people that only do property, people that only do mining. And this is just in the UK. And then we have a bank of analysts in Denver that cover, the more global stocks. So they wouldn't go down to the Ibstocks and the Marshalls of the world, definitely. But they would cover very well the likes of Astra, GSK, Unilever. If they would tell me, when not to buy National Grid, etc. Those kinds of things are, don't get me wrong, the ultimate decision sits with me and James, and we need to know those companies. But am I trying to cover 150 stocks? Absolutely not. I am trying to cover Ibstock and Marshalls and those more medium-sized companies, because there is no one else within this organization that wouldn't have the same degree of interest in those types of companies. But when it comes to Astra, etc., there is a lot of expertise within the firm that we can rely on.
So how do you collaborate with your colleagues on those things? Do you have regular meetings, or is it less formal than that? How does it work?
To be honest, it's less formal than that. I think people, it's more about personal relationships, if I'm being really honest. If I think about, say, mining, we have a woman called Olivia Vernal on our desk who covers the mining and paper and packaging sector fantastically well. She knows that she can bring me and James ideas when not everything lines up 100%. So what I mean by that is, in being more value and more contrarian, we are willing to, or we have to be willing to step in and buy at least starter positions before every box is ticked. And I think that's really important as sector analysts or as global analysts. It can be quite hard sometimes to recommend something as a buy before you think every box is ticked. The management changes in, the balance sheet's fine. That's not the way me and James work. We go into we went into something like M&S. People were almost having a little laugh, thinking, well, that's that business.
You have to take a bit of a risk to get the reward. Yes.
In being that style, you have to be willing to step over the line. So we just, analysts and fund managers within Henderson, know that that's our style and that's how we run things. So we'll bring us ideas when they think things might be on the cusp of changing, but not necessarily everything is lined up. So sorry, that's a long answer, but it's much more informal and people knowing
Thank you.
how we think about things.
Great. Thanks very much, Laura. Okay. So then we have a question from Peter. Thanks for the presentation. Dennis, you mentioned that clients find comfort in the investment portfolio when working with IPS. Is the investment portfolio separate from the IPS business? Meaning that in an emergency, could IPS access funds from it?
So the structure of the organisation is that the investment portfolio is in the corporation PLC, and then all of the IPS businesses are in subsidiaries that are wholly owned subsidiaries of the parent. Okay, so the way that we view cash as fungible between the businesses. For example, when we bought our company secretarial business, we needed £20 million to do that. We advised Laura and James that we needed the £20 million in 2 months' time, and consequently they sold down a few of their shares in order to raise that £20 million worth of cash that we needed within the subsidiaries. Going the other way, obviously what we do is we earn money every year. Obviously we dividend that money up, and that's that whole point that I made at the start, which is driving cash upwards in order to support the dividend on an ongoing basis. Was there a second part to the question there, though, Mark? Miss, was there a second part?
Well, it was, yes, just the emergency situation. Presumably, if one of the IPS businesses got into trouble.
Yeah, I mean, look,
presumably the parent would be able to rescue it.
Yeah, well, again, we would have to make...
Which gives comfort to your clients.
Yeah, we'd have to make whatever we felt was the appropriate decision as a board of the parent as to what level of support was required. But generally speaking, obviously, we mitigate these risks by putting contracts in the subsidiary. Generally speaking, these are not guaranteed by the parent. We have liability thresholds, which are obviously... we keep those to a minimum as well. So there's multiple things that we protect ourselves through legal agreements, let alone professional indemnity and other insurances that we run at the subsidiary level. But I think the theoretical answer to the question is the board of the PLC would have to make a decision that determines with the best interest of the whole at that time.
Mm-hmm. But the fact that IPS is part of a larger group presumably does give its clients some
it's incredibly helpful. It's a two-way street. It's great for Laura and James that if we can consistently make the cash profits because they have more choice, and going the other way, it's tremendous for us to be, if you're pitching for a 50-year bond, it's great to be part of, to be a bond trustee. It's better to be 135 years old because some bond trustee firms aren't even 5 years old. So it's great to be this 135-year-old FTSE 250 independent board. That's incredibly helpful for us when winning business. Incredibly helpful.
Brilliant, thanks. Then we have another question from Bob. In how many of the companies you invest in, Laura, do you meet the management? So how often do you meet management of your investee companies?
So of the small and medium-sized companies, we would meet all of them.
Mm-hmm.
I haven't met the CEO of something like HSBC, if I'm being honest, in a long time. We have a financials analyst who sits 2 seats down from me, who probably would have met him within the space of weeks ago, but I'm not sure how much insight I would realistically get, if I'm being really honest, from meeting the CEO of a company as large as HSBC. Whereas, not to sort of, we own more than Ibstock and Marshalls, it's just that they're front of mind because I met them last Thursday. Those types of management teams we meet all the time. Or something like ITV, which is, and I met them very recently, something like that. We meet very often because it's more in the value bucket. It's not particularly widely held across the firm. So something like that we would meet very regularly. And I think there is a value in doing that. But I would not necessarily meet the CEO of HSBC, Standard Chartered, GSK. I meet occasionally. It tends to be the small and medium-sized companies where we really put an emphasis on meeting the management team, because the CEO, being really frank, the CEO and the CFO is much more important, I think, at those small and medium-sized companies. Not to say the CEO of HSBC isn't doing a good job, but that's a very, very large organisation with a large bench. Whereas, the CEO of Smith, Morgan Advance. These are people that make really material decisions for the overall company. So it's important for us to get to know them.
So effectively, with some of the very large cap companies in your portfolio, you're effectively delegating the meeting management to your analysts who have a lot more time to spend on businesses like that.
Yeah,
just a comment from personal experience. I mean, it makes sense, as you say, that the CEO has a bigger influence on a smaller company, but I just quote one exception that proves the rule. From my own experience, many years ago when Pascal Soriot came in at AstraZeneca, he's made a massive difference to that business.
Yeah,
so
no,
even in a big business that big, a CEO can make a big difference.
No, you're completely right, and there is always the exception that proves the rule. I was reading an article in the FT. Some people on the call might have read it, with the CEO of Rolls-Royce a couple of days ago. He has, also, for all the things I said about end markets and fund he's made a huge difference, and he was in the running for the top job at BP, and they chose Looney over the guy that went on to run Rolls-Royce. Those types of decisions. You're right to point out that it can make a difference.
Great, thanks. Okay, so moving on to the next question. So Peter asks, you mentioned that when there's a shortage of UK stocks in certain segments, you opt for foreign stocks, such as Toyota in automotive, presumably. Is this the sole reason, or do you also consider factors like quality or valuation?
Sorry, that's probably bad phrasing on my part. We definitely do consider valuation. So, for example, Microsoft was one that we held for a very long time, and we always used to put that as the example rather than Toyota, but it did get to a valuation. We sold it too early, which, to be honest, I don't find super surprising for me and James, given how we manage things. But that was always the one that we would name, and now we have no equivalent of Microsoft. So it's not that we felt we absolutely had to have that position in tech, and that was our sort of benchmark weight in tech. When it got to a valuation that we thought was too high, we sold it. So, and equally, if we couldn't find good value in something like a Roche, we wouldn't hold it. We don't have to hold those types of names. That's completely off benchmark for us. So unless we think we can make, if we're being really, really frank, make money in some way, then we don't need to hold it.
So when things get a bit cheaper, then might be the time to look at it. So Apple might be starting to come up on your radar, for example.
If I'm being
a little bit too early, yeah.
Being honest, I think it's still a bit early.
Fair
I think
they've got
those names, they have moved a long way. When we were originally buying Microsoft, it was on 10 times earnings.
Yeah.
That
was really not to be sniffed at. Thanks, Laura. Okay. Then a question from Ian. Can you shed some light on your framework for timing when you decide to take profits and start recycling into new opportunities?
Yeah, so it's a very good question. And we don't tend to sell whole positions or buy whole new positions. So what I mean by that is that we've started to reduce the likes of Rolls and Flutter, and they're both roughly 3% holding now. You could think of that as a very rough cap, but we do sometimes let things run a bit beyond that. So we will reduce slowly, and we will also start slowly. So we will often start with 30 bits, 50 bit, so 0.3, 0.5 type holding, and then gradually build from there. It would be very unusual for us to come in and say, we're going to sell all of Rolls-Royce. It's hit our valuation target. We're much more likely to think, okay, that's now at a valuation that's more equivalent with its European peers. Sentiment has moved a long way. Valuation, we start to reduce. And at the opposite end, if we think about some things that we're buying, something like AB Foods, it's in Primark and Twinings, we've put in a 0.5% position because we think, look, that's at a 20-year valuation low. But we know that we're going in at a point when Primark sales are difficult and the UK consumer is difficult. Would I put 2% in AB Foods right now? I don't think I would. But I think the valuation is enough. The balance sheet is fine, that it's I'm comfortable putting in a starter position there. So we'll go slowly. And we are thinking of things on a 3 to 5 year time horizon, which I think is really, I think that's pretty unusual in the market at the moment, just from watching how shares move and how quickly people are changing positions and thinking around things, to have the ability to think, actually, you know what, would I buy it now and keep it for the next few years? Yeah, I would, on something like AB Food, all those building materials companies that I spoke about, so that's how we think about things. But don't expect, the turnover of this portfolio is about 20% a year. We're not swinging things around dramatically.
But it is just to make one point on that, if I can, just put some numbers around it. You can see these in the annual report. On Rolls-Royce, you can see that Laura and James have sold 37.7 million as of the year end in Rolls-Royce. Still have a position in the low 30s million from the February the 28th net asset value statement. And Marks and Spencer's, where again we've got a holding of around 14 million, but we've sold 14 million. So there is really disciplined selling that goes on within this portfolio.
Yep, that's half the art of portfolio management. It's the selling as well as the buying. Absolutely. So there's another question here about gearing, which is really how you get the gearing you want. Do you have notes or bonds out on a long dated basis, or do you use a short-term RCF? So how do you gear the portfolio?
So I'll talk about how we do it structurally, and then maybe Laura can talk about how she does it tactically. So on the structural piece, we have a number of long-dated debentures that are between 2034 and 2050. So a total of just shy of 164 million with various coupons. So that very sort of long-dated structural debt is what we have. We also have an overdraft, which we might use very occasionally, but we don't want to fund. Laura's been very clear. We've got a long-term funding strategy. We don't want to fund a long-term strategy off of an overdraft or anything other than a tactical couple of days. So we are in the process of putting in place a revolving credit facility because we haven't taken out any debt since 2021, and obviously we're a substantially larger organisation than we were today than we were in 2021, but perhaps Laura, you could deal with the tactical issue.
I don't think someone should expect us, unless anything materially changes, to move the gearing too much either way. We're not trying to time the market here, so we've had a low teens gearing for quite a while, which I think is reflective of the fact that we are seeing a lot of valuation opportunities across the piece, mostly in the UK, but so I wouldn't expect us to suddenly bring that gearing down unless anything dramatically changes. I mean, for context, this is before my time, but James de-geared the portfolio substantially going into the GFC because of the financial crisis, because he could see that valuations in areas of the market were getting particularly stretched. But outside of extreme scenarios like that, the gearing has tended to be where it is, and I wouldn't expect it to change too much.
Yeah, so you expect it to be fairly constant. Okay, and then we have another question from Ian. Really, he's asking, you've indicated that valuation is a key factor in your portfolio selections. Are there sort of thematic areas that you look at? He refers to big picture drivers. I interpret that as thematic trends.
To be honest, not hugely. I always think it's safest to come back to stocks rather than trying to make decisions on a top-down view, because I think we might get the theme right but the stock wrong. So with things like, what's everyone's favorite area at the moment, something like defense, would have done a 180 on where people viewed it a couple of years ago. We do have exposure to that type of theme, if you want to think of it like that, in the portfolio, things like Babcock and BAE, but that would not have been why we would have bought either of those positions. Something like Babcock was very much a management turnaround story from a couple of years ago. So no is the short answer. We wouldn't be making decisions on a thematic basis.
Thanks. Okay. Okay, yes, so the final question was a similar one about defence. though, there's a twist on this question, which is, do ESG considerations make it difficult for you to invest in, for example, defence?
The short answer to that is no, we don't have any sector exclusions in this portfolio. So if we think, we will of course consider ESG concerns to the degree that they're material to the share price. So if we thought, for just to give the complete 180 example, if we thought defence spending was suddenly going to fall off a cliff, we would bear that in mind in our investment case in the likes of BAE at Babcock. But the reverse is probably true. But no, we're not ruling anything out.
On that basis. Okay, well, that's really dealt with all the questions. It was a great presentation, and thanks very much for dealing with all those questions.
Could I just
Please
go with one point just before we close here? It's our AGM in a couple of weeks' time on the 11th of April. So if I can shamelessly plug the AGM, you can join online if you wish. All the details are on the website, but we'd love to actually meet you in person and talk to you. It's at Peel Hunt's offices. It's right above Liverpool Street Station. There's bacon sandwiches for those of you that get there at 10:30, and afterwards there'll be even more to eat as well. So we would love to see you and talk to you at our AGM on the 11th of April.
And I very much endorse that. We encourage our members to attend AGMs. It's a great opportunity, as Dennis just said, to meet the management of the companies you're investing in person, and of course by voting to have your say on the resolutions.
Absolutely.
Lovely. Okay. Thanks very much, Dennis. Thanks, Laura.